Inflation, what is really going on? David Macdonald returns, and we're going to discuss it starting right now.
This is Debt Free in 30. Here's your host, Doug Hoyes.
David Macdonald is a senior economist with the Canadian Centre for Policy Alternatives. He was a guest back on episode number 114, 5.5 years ago, where we discussed basic income, and he returned on episode number 319 in October of 2020 to discuss the transition from CERB to EI. That was a very popular show. I'll put links to both of those episodes in the show notes. This is episode number 449. David Macdonald, welcome back. Thanks for being here.
Thanks for having me. Third time's a charm.
Looks like every 2 years you get roped into this.
The regular invite comes in.
So I'll see you back in 2025. So I want to talk to you about inflation and your organization. Well, I guess you, because your name's on it, wrote a big study in January. Where are your inflation dollars going? That study had a lot of complicated stuff in it, which I didn't understand. So you're going to have to, I think, let's forget about that. Let's talk about stuff that I'm going to understand. We think we all know what inflation is. I don't know if we do or not, but maybe it doesn't matter if we know what it is or not. What matters is prices are up, things cost more. So when I mention inflation, what pops into your head? What are the things you think about? What are the things you worry about?
Yeah, I mean, that's a fine definition, right? What is inflation? Well, prices are higher. Now, that doesn't tell us why inflation is up or where inflation is going. So we're paying more for everything to get the same products and services we got last year or the year before. We're paying a lot more. And this is happening across a whole variety of sectors. Most recently, we've seen a big uptick in food prices in grocery stores, despite the fact that gas prices have gone down. And so when we think of inflation, what we're usually referring to, just from a stats perspective, is the Consumer Price Index. And so this is a number that's the average of prices that Statistics Canada puts together that consumers buy. It's usually compared, this month versus the same month the year prior. And this is one way to look at inflation and prices. It's the prices that consumers pay and how they are changing. So it gives us really good insight into which parts of the prices that consumers pay are going up, which prices are going down. Even if we look at it, on average across all these different price categories. So, as I was saying earlier, we're seeing continued big year-over-year increases in grocery store food prices, but actually some decreases in gas prices compared to where they stood a year ago. And so we're seeing the year-over-year inflation come down. We're just over 5% now. Now, this doesn't tell us where the money is going. We often think that inflation is bad for everybody. Everybody pays more, whether it's businesses, consumers, rich, poor, it doesn't make any difference. Everybody's paying more for everything. And that's not entirely true. And it sort of skates around the issue that we're paying all this extra money. It is going someplace. And we can track where it is going if we look beyond just the Consumer Price Index, which is the final price for consumers, further down the supply chain. Who along that supply chain is jacking up their prices that in the end is resulting in consumers' prices going up? We often think one step back. So we think whoever sold it to us is jacking up the prices and keeping all the profits. In case of grocery store food prices, who's doing that? It's the grocery stores themselves. There's some truth to that. Don't get me wrong. But there's a supply chain behind that, right? Grocery stores buy from food manufacturers. Food manufacturers buy from farmers. The farmers use diesel. The goods and those goods are trucked across the country in transport trucks that also use diesel. So who along of all those players is jacking up prices that's ending up with consumers seeing higher prices in the end? Often workers are blamed. Say, workers, look, you're asking for higher wages. That's why inflation is going up. And so one of the things I wanted to do in this study was look beyond just consumer prices changing and look at price changes across the entirety of the economy to see where all this money is going, and how can we break it down? So, the big categories in terms of costs for, up a supply chain are going to be in the business sector are going to be corporate profits. They're going to be workers' wages as well. And there's a third category of sort of kind of financial and indirect taxation costs. And so those are kind of the three broad categories I looked at. Now, the biggest of which is actually corporate profits. So corporate profits are capturing the largest, 43 cents of every dollar that's being spent on inflation. Inflation dollars is ending up as corporate profits in Canada. a portion, about a third, is ending up in higher workers' wages. And the remainder is ending up in this sort of financial cost category. But we can be even more specific than that. We can break this down by industry. So if we break it down by industry, then we get a much more detailed view of who along the supply chain is benefiting from consumers at the end of the line paying higher prices. The biggest beneficiaries by a long shot are oil and gas, mining, extraction, as well as the manufacturing industry. But the most important part of the manufacturing industry there is petroleum manufacturing, which is otherwise known as oil refining. So turning crude oil into diesel or gasoline, those sort of things. The other two big industries that are benefiting from inflation are the real estate and the banking industries. So if you take just the profits in just those four industries, it represents about half of every dollar that we're spending. Inflation dollar that we're spending is ending up in those four industries as profit. And so you can see that there are winners when it comes to inflation, something that I don't think we usually recognize or even look into. They're absolutely winners. We think everyone's a loser. Everyone is not, losing from this. There are clear winners. And so we can see it in record profits in the oil and gas sector. And so, when we talk about workers' wages, we often blame workers for this somehow. But workers' wages consistently over the entirety of this inflation period, which started about 24 months ago, in 23 of those 24 months, workers' wages were increasing, but they were increasing at less than the rate of inflation. So in essence, they were falling behind inflation in any one of those periods, except the most recent period, which is, the one period where they exceeded inflation in a given month, which just happened in February. Otherwise, they've been losing over that entire period. And they've been losing to corporate profits. And so you actually see a fundamental realignment in the GDP statistics on the income side, where you say, who benefits from economic growth? Is it profits? Is it labor? Or is it sort of some of the other wage categories? You see profits at near all-time highs of GDP, at or near, depends on the quarter. You see workers' wages not quite at all-time lows. But one of the things that you do see at all-time lows is mixed income, which is basically small business income. You do see that at all-time lows. And so there's been this realignment over the inflationary period towards corporate profits and away from worker compensation as well as small business revenue.
So let's unpack a few of those things because there's a lot there. And let's start with the CPI and then go back to what you just talked about, which is more of a GDP view of it than a CPI or a start of the chain rather than an end of the chain look at it. So the inflation rate, so we are recording this on April the something, I don't know what day, April the 3rd is it today? April the 4th? I'm not sure what date it is today. So the most recent stats we have are February numbers, because the March numbers aren't going to come out for another, I think, until probably 10, 15 days from now. So the CPI in February was 5.2%, and that means inflation, measured by that, is up 5.2% compared to 12 months ago. That's what that number is. That number peaked in June of 2022 at 8.1%. But if you go back to when the lockdown started, April and May of 2020, that number was actually negative. Does that make sense? That we actually had negative inflation, if you want to call it that. Now, kind of easy to understand why, I guess. No one could do anything. No one could spend any money. So kind of hard for prices to go up. So your point about corporate profits, if we were to turn back the clock to April and May of 2020, were corporate profits negatively impacted then as compared to positively impacted now?
Oh, yeah, they were negatively impacted. And so what you see in any recession is a bit of a common trend. You see corporate profits go down first. You then usually see workers' wages come down. There's a bit more of a delay. And then, you would see a recovery on the other end. And usually corporate profits come down more steeply. They come down quickly, and then they go back up more quickly. And so they are kind of like they often bear the brunt of recessions on the income side. Now, we certainly saw that in this recession.
So you just mentioned the word recession. Are you referring to the very brief recession during 2020? Or are you referring to the recession that we may or may not be heading into now?
Yeah, 2020, exactly.
And if you and I were to talk at Christmas time, would we be talking about the recession, or would we not be talking about the recession? Are we
recession in 2023? Is that what you mean?
Yes, that's my question. Are we going to have one officially declared in 2023?
Well, get out your crystal ball. I mean, I certainly think that the downward revisions that finance made in the last federal budget suggest that's quite possible. The Bank of Canada thinks there will likely be a recession in 2023, albeit relatively mild in both cases. But I think that's, it's probably 50-50. We've seen, the first couple months of this year of 2023 have actually been fairly positive in terms of the monthly GDP numbers, although the last quarter of 2022 was basically neutral. And so that was a lot less than what was expected. So, it's still a mixed picture, and we're not in a recession by any stretch. I mean, a recession being sort of two quarters of negative GDP growth. We're not in, to get 2 quarters, you need 1 quarter. We're certainly not in the first quarter of negative real GDP growth yet. That doesn't mean it couldn't be, in Q2 of this year, Q3, Q3, all those are possible. But we're certainly not there yet.
And you use the word real, which you mean after factoring out inflation. So the economy is still growing, even ignoring inflation. Is that what you're saying?
Yes.
Okay. Now, you also used another phrase, time lag. And this is something people don't understand. If I eat a bag of Oreo cookies every day for a year, I don't get sick on the second day. By the end of the year, okay, well, it takes time and I'm not going to be feeling so great. So everything that happens, there is a time lag to it. So you said that corporate profits get hit first in a recession, but they recover first. I guess it's a first in, first out thing. And then we've got employee wages. So let's focus on that, because the people who are watching don't really care about corporate profits. They're people, actual real people. Okay. And we can debate what corporate profits, what that means. I guess if you're a corporate owner, then it's a good thing, buy shares. But if you're somebody who doesn't have money to be investing in the stock market, I guess corporate profits are not as good a thing for you. But let's talk about wages then. So what you said was employee wages, I guess that's the only kind of wages there are. Wages are increasing, but they are increasing slower than the rate of inflation is increasing, which really means in real terms, they're going down.
Yeah.
The purchasing power of wages is going down. So can you give me a rough idea? So if the inflation rate was 5.2% as measured by the CPI in February of 2023, you said that was the first month in a long time wages were actually up by the same or higher of an amount?
That's right.
But every other month pretty much for the last couple of years, the inflation number has been higher than the how much wages have gone up. Is it possible, again, pull out your crystal ball. I know you can't see the future or else you'd give us all the lottery numbers. But is it possible that wages will be increasing over the next few months faster than inflation, or is that just not the way the real world works?
It's possible. Yeah, it's possible. I think there's likely, again, a delay between when companies can raise prices and therefore profits, and the time when workers say, hey, wait a sec, these prices are a lot higher. I need a raise. And so they can do that by switching jobs. They can say, look, this job that I have doesn't pay enough. I'm going to switch jobs. They can do it through collective bargaining if they happen to be a union and say, in the next round of bargaining, we need a big pay raise. Like we can't get 2%. We need 5% or 8% or something like that. Or they can sort of negotiate directly with their employer and say, that review, my employee review, yeah, I need a bigger pay raise. It can't be 2% this year. And so there's going to be, I think, there's going to be a delay where employees are trying to catch up for the fact that inflation happened. It happened, it started 2 years ago, basically, where you see inflation over 3% outside of the Bank of Canada band. And now you're playing catch up as a worker. And so it's certainly possible that workers have, sufficient power in various ways, potentially due to a tight labor market, to bid their wages up. it's going to be a while before they're made whole with respect to prices. But for a couple data points, it's certainly possible.
Now, you mentioned the phrase tight labor market. So do you believe there is a tight labor market? And that sounds like a silly question, because if you look at the unemployment rate right now, it's, I don't know what it is, 3%, something like that. Like it's a pretty low number. The counter argument would be, that's a bogus number. And it's bogus for two reasons. Number one, the labor force participation rate is, if you look at the last 20 years, it's been going down. I mean, it's spiked up over the last couple of months, but it's been going down for many, many years. And the other reason it's bogus is employment is a binary number. You're either employed or you're not. Well, that's not how it works in real life. You could be working for 35 hours a week. You could be working for 40. You could be working for 50. And I don't know if we have the same thing in Canada. In the United States, they have two different employment surveys, the household survey and the establishment survey. One of them counts how many people are working and how many, from the employee's point of view. The other counts it from the employer's point of view. So if you're working two jobs in one of the surveys, you count as two. In the other, you only count as one. I don't know if we have something similar to that in Canada or not. Because I didn't do any research for this show, so I don't know. I'm just throwing stuff out here. But what is your take on the unemployment number? Is it a real number? Is it really as low as it seems, or are there cracks starting to form that, okay, we all were working overtime, now we're all working 40 hours, then it's going to be 35 hours, and as a result, incomes are going to fall? What's your take on unemployment?
Yeah, in terms of the surveys, there's similar surveys. There's the labor force survey, which is the survey of employees. Or workers, and then there's the SEP, the survey of employment, payroll and hours, which is the survey of employers, and so you can get kind of the perspective both ways. Certainly, over the past couple months, we've had continued very strong employment numbers. It's not to say that your wages are above inflation; they aren't. But in terms of employment numbers, it has been very strong. Not quite historically low, but really quite low. That's true in general. It's true when you look at some of the sub pieces of the market. If you're looking at particular, racialized workers from particular backgrounds, women, when you're looking at participation rates rather for prime working age, they're at historic highs. They're at historic highs for women in particular. It's a very positive labor market in terms of your ability to get a job. And so, one of the interesting trends that happened during the pandemic was that the first people, the people that disproportionately lost work were low-wage workers. Half of everybody who worked at or near minimum wage lost their job in the first couple months of the pandemic. And this was unusual. Certainly, low-wage workers are commonly among those losing a job during a recession, but it's often matched with workers in other sectors that tend to be higher paid. So if we look at like the 2007 and 8 recession in Canada, yeah, you certainly, retail and tourism got sideswiped just like they did this time around. But so did oil sands workers, who tended to be much higher paid, frankly. And so you get sort of two parts on the income spectrum that gets hit, because there's the sector that gets hit because it had to do with the recession itself. And then there's kind of discretionary spending that gets hit in any event. That wasn't the case this time around. During this pandemic, it was very clean that, the less you got paid, you were just far more likely to be laid off. And the more you got paid, the far less likely you were to be laid off. Because you could work from home and that sort of thing. What's really interesting coming out the other side of the pandemic and through the experience of CERB is they saw the great resignation in the US following the rehiring, where people just went back or they resigned from their position, looked for other jobs. And so you get this big boom in people quitting and looking for other work. We didn't see it in Canada. And I think there's a reason for it, which was that over the course of the layoff period starting in March 2020 all the way through the summer of 2020 and early fall 2021, we had very strong programs like the CERB that gave people a lot of certainty in terms of what they would make. And so instead of quitting as things reopened, they just didn't go back to their previous jobs. They just got a new job because they had a couple months to do a proper job search. Maybe they boned up on some educational requirements that they needed, beefed up the resume and that sort of thing. And so you see this fundamental shift in the rehiring that folks don't go back to those low-wage jobs. They still exist, and those folks really need people to go work there. But the people who used to work there don't work there anymore. They got a job someplace else. And one of the reasons why we're seeing these very high job vacancy rates in some industries is the workers are gone. The experienced workers who used to work in places like food and accommodation, used to work in retail, they left, and they're not coming back because they're probably getting paid better in another area. And that's one of the explanations for some of the increase in wages is that you see this shift. Now, what's interesting when we talk about this, the employers complaining of a worker shortage, it's important to point out that the perspective is a worker shortage at the wages being offered. That's, that little proviso at the end is often missing from that sentence. And so you can actually, what's interesting is part of the labor force survey asks people in particular industries who are seeking work in particular industries, how much, what are you looking for in terms of a wage? At what wage would you go work in a particular job? And you can compare that to job postings to say, how much are these job postings offering? And you can split up industries and the job posting, this massive surge in job postings. How many of those job postings are in industries that aren't offering what people are willing to work for versus how many are in places where they're offering what workers are willing to work for, but they still can't find the workers. So you break the industries up into a wage shortage and a worker shortage. And about 2/3 of the job postings are in a wage shortage category. So, you're just not offering enough for people to go work. And so, some of the big ones are going to be food and accommodation, retail. These are areas that are historically terribly paid. There are a lot of part-time work, a lot of hours issues. And so surprisingly, people are going to be warier of taking those jobs, especially if they have a choice. And other areas, concerningly, like healthcare, are areas where it seems on average like they're offering enough wages. They just can't find the workers. And so here, it's probably a more complicated picture where people don't have the right credentials, or they've quit to go do something else, or they've retired. And so you legitimately you just don't have the right workers to fill those positions. And that's kind of worth understanding when we start talking about a tight labor market is why is it tight? And you can certainly imagine the reason why some of the food and accommodation jobs aren't being filled is because the employers can't pay higher wages. Maybe they want to. They understand the problem, right? Which is the wages aren't high enough, but maybe they're not bringing in enough money to pay higher wages. And so they're just perpetually short-staffed. You could imagine a fast food restaurant where, they just can't willy-nilly raise prices because those prices are governed by, the franchisor of their fast food restaurant. They're being squeezed on the wages side, but they just don't have a lot of choice. And so they just shut down. They used to run 24 hours. They can't run 24 hours. And so there are various reasons for why we're seeing this tightness in the labor market, but it certainly puts more power in the hands of workers, potentially to increase wages. And we're seeing that to some degree, although not as much as inflation. It certainly gives them a lot more power to get a job in the first place, even if wages aren't commensurate with the increase in prices.
Yeah, and I see it on both sides because I have people calling me who are employees, and it's like, I'm not going back to that restaurant because they're only going to give me 25 hours a week. So even if they do pay me a high hourly rate, it doesn't matter. I can't survive on that. And I hear it from the small business owners as well, who tell me, yeah, I definitely hire more people, but I can only charge so much for a hamburger. And if I charge that much, and of course my inputs are gone up, the price of the bun, the beef, the lettuce, everything's higher. So we're kind of getting whacked at both ends. So what then? Let's bring this down to the level of the individual then. And I go back to the word I wrote on my sheet, time lag, because, over the next number of months, I guess the other key point you made is you cannot look at the economy because the economy is just a thing. It's the individual people in it. So there are individual people whose skills are in high demand and they can, demand premium wages. There are other people who perhaps are not in that same boat. So at the individual level, if you are in a job right now and you think you are being underpaid, is this as good a time as any to be casting a wider net?
Yeah, I mean, that's unfortunately one of the ways that people get wage increases is they get another job. It has been a relatively tight labor market for some time. And so, I mean, it certainly depends on where you're working. But if you are interested in a pay increase, I mean, you can certainly talk to your employer, and that's certainly one way to get a pay increase, but it's unlikely that you'll get the same kind of pay increase as if you switch jobs. Now, it's probably not great advice to say quit your job and then go look for another job. It's better advice to go look for another job first and then quit your previous job. But now is a great time to look for another job that could potentially increase your pay a fair amount. You're not looking for 5% here, you're looking for 10, 20% increase. And those are certainly possible. I mean, you look at areas like professional services. This is an area that's seen a huge boom in employment, but also in wages. And one of the areas within professional services that's quite important is the growing importance of IT. As the work from home trend is not going away, there's a huge upswing in the need for IT workers that are setting up Zoom calls in people's houses, and the printers don't work. People are working from home, and so on. There's a huge demand for this, and so I mean, if you're anywhere near this field or anywhere near fields like healthcare, there's great opportunities for potentially moving to get better work environment, potentially increase wages. Although I should say actually that a lot of the areas that are keeping wages down are public sector employment. So this is certainly healthcare, certainly education, public administration in general are areas where wage gains have been very low. Part of that's government policy. So part of it is, provincial governments attempting to keep wages very low in wage settlements. And part of that is likely due to delays in terms of contracts. So you've got a contract for 3 years. It says it's 2% every year for 3 years. It hasn't yet come up for negotiation. It will likely come up for negotiation in the future. And so therefore, there will likely be opportunities for pay increases in some of those areas that are heavily unionized in the future, even if we haven't seen them so far.
Which goes back to the whole time lag thing. If you got a 3-year contract, it's like having a 5-year mortgage on your house. Well, the interest rates don't matter until it comes time to renew. And that's what we're seeing now. Final question for you, since this podcast is called Debt Free in 30. What comments do you have on the world of debt? I mean, I see the stats and I can see that credit card debt is now higher than it was prior to the pandemic. It had a big deleveraging. It went down quite a bit, and now we are back higher than 2019 levels. Do you expect that trend to also continue?
Yeah, I mean, this is one of the worrying trends in terms of changes in debt levels. I mean, the big driver in debt is, as it always has been, is mortgage debt. This is overwhelmingly the type of debt that Canadians have on a dollar basis. And it's been sort of relatively consistent. It hit higher levels prior to the increases in interest rates around this time last year. And its growth rate has slowed somewhat since then, unsurprisingly, because there just aren't as many houses being sold. But when we look at some of the other types of debt, we actually saw credit card balances decline by almost 20% year over year, ending in April 2022, the spring of last year. There's a huge decline in credit card balances. But then they really saw a big upswing starting in 2022 so that they weren't negative anymore. And now they're running at, they're increasing at about 15% year over year for the last couple months worth of data, which is pretty concerning. We've also seen an increase in lines of credit and the use of line of credit. That happened slightly earlier, with credit cards really kicking in the last year or so, where we're seeing just consistently, every single month, much higher credit card balances. Of course, these come with much higher interest rates. And the potential that if what's interesting is that the interest rate paid on credit cards is certainly, like, the raw rate is certainly related to what's happening at the Bank of Canada. But whether you incur interest rates or not is basically entirely dependent on whether you make the monthly payment or whether you pay the full amount. If you're paying the full amount, it doesn't really matter. You're not paying interest rates ever. But if you can't make that full amount, now you're paying closer to the minimum. That's when you start incurring substantial interest rate costs. One of the other concerning features is when you take a look at the changes, really recent changes in net worth across different segments of the population. Net worth is universally down for all Canadians. High net worth, middle income, low net worth, it doesn't matter. Everybody's losing ground, but it's for very different reasons. And so when we look at high net worth is down for the richest Canadians, but it's down because asset values are down. So this is related to, house prices, secondary real estate holdings, to some degree stock and bonds, but it's largely related to real estate. It's down in the middle, again, because assets are down, primarily house prices are down. But at the bottom, it's not down because asset prices are down, because the bottom doesn't often own houses. They often rent, and car values aren't down particularly. Its net worth is down because debts are up, because liabilities are up. And so here's the concerning feature, and this isn't entirely clear at this point, but I suspect what's happening is that debts are up in those higher interest categories like credit cards, like lines of credit, and that a lot of that is happening for folks that have lower incomes. Now, the job market is strong, so if you need a job, you can get a job. The issue, though, I think, is as people are trying to deal with higher prices, they are dealing with higher prices through these higher debt loads in areas where interest rates can be very high if you start to get into trouble. So, if we did end up with a recession, if it is slightly harder to get a job, it may be some of those lower income folks that get hit first, and they're leveraged in areas that have very high interest rates, which can be very dangerous.
Yeah, and we certainly saw that. We released our Joe Detterhoy's Michaelis bankruptcy study in February, and there's certainly an increase in what we call rapid loans. There used to just be payday loans, but now we've got the same lenders who are giving these installment loans that can be $5,000, $10,000, $15,000, but they are still very high interest rate loans, 45, 50%. So you're right. If that's how you're borrowing, then your debt levels are going up. The other thing that's affecting net wealth, certainly at the low end, is tax debt. So you and I talked about CERB a couple of years ago. There are still lots of people calling me who have CERB debt, either the taxes they owed on it or the government says they got to pay it back. Then you had 2021 where they got CRB through EI, full taxes not taken off, any interruptions in employment. So the clients we're seeing now have a lot more tax debt than they had 3 years ago. So all of those factors are factoring into it. So there's both good news and bad news, I guess. There is the potential to get a job if you've got the skills that are in demand, but the costs are higher. You've got higher costs to balance that out. What advice then, what final thoughts do you want to leave people with? You've already given us one thought, which is if you are in a job and you think you are undercompensated, well, now is the time to be looking around. And we're certainly not saying to anyone, quit your job. We're saying have your eyes open. The problem with quitting your job and going somewhere else is now you're the low person on the list. So if things go bad at the new employer, well, I guess you're the first person to get laid off. So great, you got a higher wage, but you're put yourself in a more vulnerable position. So you gotta think these things through. But I guess if you were able to get that job, well, probably you'll be able to get another one too, perhaps. So other than keeping your eyes open and looking at the job market, what other practical advice would you give to a human being, not the corporations, but a human being who is watching us here today?
Yeah, I mean, there's certainly clouds on the horizon. This is likely the best time that folks will have in the employment market for a while. It might get slightly better in terms of wage increases. But, broadly speaking, this is a really good labor market for folks. There may be some wage increases coming, but you might be able to accelerate that through, your own planning. In terms of prices, we didn't talk about this a terrible amount. I mean, we usually compare the prices year over year. And so, with respect to that, I mean, the headline number is just over 5%, as you talked about earlier. But if instead of looking at 12 months, we look at 9 months, so we cut a quarter out of that, we're already down close to 3% in terms of price growth. The Bank of Canada thinks inflation will be around 3% by June. So we're closing in on lower, inflation coming down. I think people mistake that for thinking that prices are coming down, but that is not the same thing. That would be negative inflation. We are certainly not going to see that anytime soon. But the rapid increases in prices are likely a thing of the past, even if they remain high. So these high prices aren't going away. We need to get used to that. The plus side for people with debt is that, in essence, if you're seeing wage increases, your debt is devaluing vis-a-vis your income. So it's not a great time to put on more debt. But if you had debt prior to the pandemic and you've been employed, the debt is becoming less important with respect to your income, which is positive for you as a debtor. I suspect most of the folks you see aren't sort of carrying debt long term, but they've hit, a much more critical juncture where the debt has overwhelmed them. And so, it's hard to see how that situation in particular is going to get better. We're not seeing huge default rates at this point, but that's going to be likely a trailing indicator as, if asset prices decrease. So we keep seeing house prices go down. If you have that as an asset, it becomes a less valuable asset that you could potentially sell to offset some of those debts. And so I would say, the clouds are mounting on the horizon. They're not here yet. So now's a good time to make a switch, to get a job if you don't have one. But this is likely a high point for most folks in terms of the ability to pay down debt and manage debt.
Yeah, I think that's an excellent point. We all have recency bias. We think that tomorrow is going to be exactly the same as today. That's not true with Canadian weather, and it's not true in the economy either. So if you are in a good situation now, take advantage of it. As you say, if you don't have a job, this is a good time to be looking for one. If you have debt, this is a good time to pay it down because you don't know what tomorrow will bring. So, well, David, that was fantastic. I've got 900 other questions, none of which I got to, but we'll have you back on in 3 years, I guess, because that's what our schedule seems to be, and we'll go through the rest. Once again, it is the Canadian Centre for Policy Alternatives, where you are the senior economist. What I will do is put a link in the show notes to your organization. You've also got a Twitter account. Is there any other place you would like me to direct people to?
No, those are great. Those are great spots to see more information about all of our analysis of this situation as it unfolds.
Yeah, and I think your data, your analysis is good because you can read through it. Whether you agree with it or not, that's not the point. You want to see as many different perspectives as possible, and I think that's where it has great value. David, thank you very much for being here today.
Well, thanks so much. Thanks for having me.
Thank you. That was David Macdonald, the senior economist at the Canadian Centre for Policy Alternatives. I will put links in the show notes to everything we talked about, both on YouTube and the audio version of the podcast. So please check those out. If you are watching this on YouTube, click all the buttons, links, and you know what they all are, all the buttons to notify you of the next one. Subscribe to the podcast. We have a new one every week. There will be another one next week. Until then, thanks for listening. Thanks for watching. I'm Doug Hoyes. That was Debt Free in 30.